This is a debrief for drafting and interpreting financial statements, looking at the AAT sample assessment number 1, and we're focusing on task 7, which is related to interpreting the information in financial statements, and in particular relating to the ratios that we may have calculated. So we can see in this case we're looking at a particular company and we are presented with 4 different ratios. We have interest cover, trade payables payment period, current ratio, and return on capital employed. And the requirements we can see towards the top of the screen. We need to identify whether the ratio is better or worse compared with the industry average, and also explain what this comparison may tell you about the company. So there are 4 ratios. So notice that we're going to be getting 1 mark for each of them to say whether it's better or worse. And then there are 4 marks for each for telling us about the company. And so a maximum of 5 marks for each ratio. Now in the real world, we may have difficulties in interpreting ratios because it really depends on the business, it depends on the industry, it depends on your point of view. So we need to use the AAT sample assessments to help us to understand what they expect us to be saying in terms of our interpretation for these. So in the first one then we have interest cover. So let's remind ourselves what interest cover means. So interest cover is the profit before paying the interest, so that would be the operating profit, and we divide by the interest expense. So we want this number to be as big as possible, because the bigger it is, it means the more profit we have available to be able to pay that interest. So if we look at the table on the left, we can see that for this company, they have an interest cover of 6.7 times, which means they have 6.7 times as much profit as they have interest that they need to pay. Whereas the industry average is 4.1 times, so it means that this company has a better level of interest cover. It has more profit available to pay the interest than the industry average. So that's a good thing. And then in the comments box, well, what does that actually tell us about the business? And there are 2 approaches to help you earn your marks here. Remember, there are 4 marks available. So one of them is to take a mathematical approach, and that's to focus on the formula that we have and make a comment about the number on the top, the numerator, and make a comment about the denominator on the bottom. And then another approach is to think about the commercial aspect. Why has the number on the top changed? Why has the number on the bottom changed? So in this particular case then, for interest cover, the numerator is the profit before paying interest. So we can make a comment that Global generates more profit than the average company in the industry. So yeah, we know that the interest cover is bigger and therefore the numerator must be bigger. We can similarly do the same for the denominator. So Global pays less interest than the average company. So remember, the interest cover is bigger than the industry average, which means that the denominator must be smaller than the industry average. But the next thing is, well, why is profit bigger? Why is interest smaller? So let's think about the commercial reasons why these numbers are different to the industry average. So to help us, let's understand, for example, on the denominator, what is that interest figure? It's going to be the value of the loan multiplied by the interest rate. So if either of these are lower than the industry average, that's going to be the explanation, isn't it? So if either Global has managed to negotiate a lower interest rate on its borrowings or just has smaller borrowings, then its interest expense is going to be smaller. We could also comment that given that the interest cover is bigger than the industry average, then probably Global is just a little bit more creditworthy, and any future borrowings it wants to undertake would probably be a bit cheaper than the industry average, which is a good thing. The next one relates to trade payables payment period. And rather than scrolling up and down on the screen, I'm just going to leave the table on the screen and just use the boxes that we have visible at the moment. So again, for us to understand what we mean by this, let's write out the formula first of all, and this is going to be the approach you should be taking in your answer. So payable days is the value of payables, and we divide by our credit purchases. Now note, in your assessment they may not give you the credit purchases figure, so often we will substitute cost of sales instead of credit purchases. But the correct formula is to divide by credit purchases, and then we multiply by 365 days. So in the table on the left we can see that the company has a payable days of 45.8. So that means on average it takes 45.8 days for the business to pay its suppliers. Whereas the industry average, it's 37.2 days for the average company to pay its suppliers. So is that a good or a bad thing? Well, it really depends on your point of view. In the AAT sample assessment, it says that the ratio is better than the industry average. So why is it better? Because if we take longer to pay our suppliers, that means that we have controlled our working capital better. The cash is sitting in our bank account for longer rather than giving it to the suppliers earlier. Again, arguably that may not be a good thing, but as far as the AAT sample assessment is concerned, it says that this is a better thing. So you should also choose better if this comes up in your assessment. So in terms of comments, again, let's look at the formula. So on the numerator we have payables. So why is the payables figure getting bigger? So the obvious reason is that the payables number is getting bigger because we're not paying them. And it could be that we're just paying suppliers later. And what we need to understand is why is that happening? So it could be that our company has negotiated longer payment terms with those suppliers. But how is that possible? Most suppliers need the money, so why would they agree to us paying them for longer? So it could be that Global is just a bigger company than they are, and they're keen to keep Global buying from them, and therefore they're willing to agree to any terms. So it could be that Global just has more power than those suppliers. Or it could be that Global is just struggling and it doesn't have any money to be able to pay those suppliers. So it's paying 8 days more slowly simply because they don't have any cash. And that's not a good thing. And the risk is that Global will suffer poor reputation amongst suppliers, and it may be difficult to buy from suppliers in the future if we're not going to pay them quickly. The next one we have is the current ratio. Again, let's remind ourselves how we calculate this. The current ratio is current assets divided by current liabilities. And I've broken up the current assets into inventory plus receivables plus cash. Because remember, we need to generate marks for commenting on this. So the more numbers in our calculation, the more things we have to discuss. So we can see that Global Industry Limited has a current ratio of 3 to 1, whereas the industry average is 2.1 to 1. So is this better or worse? Again, this really depends on your point of view, but in the AAT sample assessment, it says that this is better. So we want to make sure that the current ratio is at least 1. Okay, that's the minimum. If the figure is less than 1, we would be worried because it will tell us that we don't have enough assets that are going to convert into cash in the next 12 months to be able to pay off the liabilities that fall due in the next 12 months. See, our minimum expectation is that the current ratio is at least 1. So with the industry, they've got 2.1 to 1. That means the industry average company has about double the amount of current assets as they have current liabilities. So that's good. They should have enough to be able to pay those liabilities. Whereas Global Industry has 3 times as much, so they have more current assets to be able to pay off their liabilities. And that's a good thing. So what comments can we provide on this? Again, we can just start off by looking at the formula mathematically. If the company has a better than average current ratio, it means that the numbers on the top, the numerator, are going to be bigger, and the denominator, the current liabilities, are smaller. So that provides us with a number of answers. So we can break down our answer and say that their company's inventory is bigger than the industry average, and receivables are bigger, cash is bigger, but also current liabilities are smaller than the industry average. But if we want to build up some more marks, what we also want to do is think about the commercial reasons. Why is this the case? So potentially the inventory figure is bigger than the industry average because they could be building up their inventory for some planned marketing campaign. So they're going to be selling more inventory in the next few months, and so they're building up their inventory for that. But also it could be a bad thing, couldn't it? It could be that they're just struggling to sell their inventory, so they're building up some inventory because they're struggling with sales at the moment. So yeah, we could be suggesting that this is a worse position. Having a current ratio of 3 rather than 2 is not necessarily a good thing if the reason is that they can't sell their inventory. Or the reason could be that they're struggling to collect in their debts from their customers. Or it could be that they're just holding too much cash, and it would be a better idea to move some of that cash into some sort of long-term investment where they could be earning more interest. Okay, so I'm not going to write up all of those ideas on the screen here, but you get the idea that we can make a comment about each of the components. It's probably not a good idea to talk about the current liabilities here, because we said the current liabilities are smaller, but in the previous part of the question we identified that trade payables are going up. So yeah, those two things don't really align with each other, so it's quite difficult to provide a comment about why the current liabilities are getting smaller. Finally, we're looking at the return on capital employed. So here's the formula. The return on capital employed is the operating profit divided by the two sources of capital we may be using in the business. So we have our equity, that's the capital provided by the shareholders, and then we have the non-current liabilities, and that's the capital provided by banks, for example. So this is trying to measure how effectively we're using the capital to generate profit. So we've received money from the shareholders and we've received money from the banks. We're going to buy assets with those bits of capital, and those assets should be generating profit for us. So we want this number to be as big as possible, and we can see in this case Global Industry Limited has a return on capital employed of 12.7%. So that means that the money injected by the various people, by the shareholders and banks, are generating 12% of its value in terms of profit, whereas for the industry average it's lower at 10.3%. So in this case we can see that the return on capital employed is better than the industry average. Yeah, we want this number to be as big as possible. So in terms of comments, again, we can do this from a mathematical point of view. If the number is bigger than the industry average, it means that the numerator, the number on top, is better, or the denominator is smaller. So we can talk about either of those to earn some marks. So in terms of the numerator, we can say that Global is generating more profit than the average company. But also it could be that the denominator is smaller, so Global has less share capital and less equity than the average company. Or it could be they have borrowed less than the average company. So commercially, why is that the case? Well, it could be that they've used their capital to invest in more efficient assets, and those assets are generating more profits than some of the industry average assets. Notice that the first comment we also said for the interest cover, and also the third comment we said that for the interest cover as well. And in the AAT sample assessment answers, it does give credit for recognizing that these numbers are connected with interest cover. So there we are. We've looked at the 4 different ratios, and the key technique was to provide comments relating to the mathematical formula, so comment on the different numbers in the formula. But it's also important to build up your marks that you should talk about the commercial reasons. Now, clearly we don't know this business. We don't know why they are better or worse at doing things. So you will need to speculate, but as long as your answer is plausible, then you're going to get credit for that in your assessment. The final part of the question asks us to recommend, with one supporting reason, whether Elise should offer Global Limited extended credit terms based on her primary concern of solvency. So we need to think about the various numbers we've looked at. We saw, didn't we, that the interest cover was quite good, and we had interest cover that was quite high as well. It was better than the average, but it had 6 times more profit to be able to pay interest, so that was a good sign. We saw the current ratio was also good. They have plenty of current assets available. We saw that the return on capital employed was quite good as well. The only one perhaps a bit worrying is that they're taking a bit longer to pay their suppliers. So is there a risk that we may not be able to pay Elise on time? But overall, the credit terms, I think, should be offered because most of those ratios were quite positive in relation to the industry average. So it would suggest that Global Limited is more solvent than the industry average. So in summary, yes, we should extend credit terms because Global has better solvency and performance.